Welcome to the first live show of 2025 and to You and Your Money. And for those who are watching the show for this first time, I would like to share with you what You and Your Money is all about. I deal over a 6-week period with investments, estate and tax planning, financial and retirement, healthcare, short-term insurance, and I rotate those subjects. This year, I plan to add investing in property and general subjects such as what individuals need to be aware of when it comes to inflation, rising costs, with difficulties of making ends meet. And I'm absolutely thrilled to see my new format. It's the first time I've seen it. We're all watching this together. And with this evening, we're focusing on the investment world. And joining me this evening is David Shapiro, Chief Global Equity Strategist at Sasfin Wealth. David, I hope you had a good holiday. Hope you're recharged and ready to go, energized.
I was happier until I watched the football last night. But as an Arsenal fan, so that's put me in a rather grumpy mood. So if I've got a scowl on my face, you know exactly why.
Well, for new time viewers, they'll know I'm a diehard Man United, but Harry Joffrey is diehard Liverpool. So we've all got our teams. David, I must say that there's the strong performance of the Nasdaq and the S&P in 2024. I mean, up around about 24, but made up of maybe 7 to 10 stocks. So people say, why aren't I invested in that index? Isn't that where I should be? And it comes back to the whole format of investors. They don't always look at their overall portfolio, how they've done. And I've looked at portfolios that you've managed for years where you've beaten inflation, the mandate that you set with clients, which you agreed upon to beat inflation 4, 5, 6% consistently year in, year out. And all of a sudden, everyone is focusing on this. The dangers of focusing on this and losing sight of what your mandate is. How are you coping?
It's not with difficulty, because I think people are influenced by the latest headlines. And you know what's very interesting, and I'm going back, the whole AI story only broke late 2022, which was a bad year for the Nasdaq. And at that stage, no one knew what this is going to be and where it's going to lead to, particularly the huge investment that's needed. So this is not an old story, it's a very new story, and we don't know where it's going. But what did underpin 23, and to an extent, 24 mainly, was the huge amount of money that is being spent building out infrastructure for artificial intelligence, which includes not only the chips that go into the data centers, but a whole lot of other things as well. And even at this stage, we're grappling with where this is going. Is this sustainable? Is the spend going to last? So there are a lot of questions out there. When it comes to the AI, when it comes to the NASDAQ and the S&P, it's very neatly packed in there. But if you unpack those, sometimes the risks that we're taking by going into the S&P and NASDAQ are not the kind of risks that your compliance officers would allow you to do, even if you are in those indices. So that was this whole story of 2023. But I think you made a very important point, and I just want to go back to, is that we never set our mandate as trying to beat those indices. We always say, what's the risk-free rate? Okay, and that could be, I use the risk-free rate, I use the US 10-year Treasury. In other words, the long bond there. You could use the inflation rate, which is slightly lower. And my whole aim is to try and beat that by a few percentage points. So at the moment, your S&P risk-free rate is, it's nearly 5%. It's just kicked up now. We can discuss why it's kicked up now. I'm sure it's going to be a question. And that's what we try to beat consistently, which we've done. The US Treasuries have been 2, 3, 1% over the last few years. So if you got 5 or 6% consistently, 7, 8, 9% consistently, you've done very, very well. You've increased your wealth because you've beaten the risk-free rate, and in that you've actually beaten inflation as well.
David, you spend time in the United States of America. You've got a daughter there, you've got grandchildren there, you've got connections there. Yes. The average American is very happy to get 4 to 5% about inflation. The average American isn't wanting the 20, 25% returns.
The average American puts his or her money in muni bonds, which gives 4% per year. 4-3. Yes, it might be tax-free. I don't know what the tax implications are, but that's generally the hurdle that we try to get through. So no one thinks of getting 23% or 24%. You know, it was a wonderful year. It was an aberration year. I hope we come close to getting that again. You know, there's a lot of discussion about where we're going in 2025. But the one thing I can say, no one can make a forecast. The one forecast I can make with a high degree of confidence is that we're not going to repeat 2024.
Yeah. Then, David, let's just talk about, because we've had a strange start. Normally what happens, come the end of December, there's a lot of balancing for American taxpayers.
Yes.
They start to sell stocks that have lost money and then take some profit so they can not pay the tax. And then normally the first week, 10 days of January, is quite positive to markets.
Yeah.
It's been very different this year. There's a lot more volatility. And you mentioned the treasury rates going up again. So just share with us the volatility this first 10 days.
This is what we have to go through. I don't know if people really appreciate it, because if we go back last year, September last year, Fed Chairman Jerome Powell reduces rates in the United States by a half a percent, 50 points. And subsequent to that, there were 2 further reductions of 25 points each. So he reduced interest rates by 1%. We built into our views going into 2025 that there'd be another at least 100 points, 4 times 25 points, or even more than that rates would come down because inflation was under control. And suddenly in December, we get the Powell flip-flop. Suddenly, hold it, boys, not so fast. We're not going to reduce rates, slower pace, inflation is still sticky. And even that has now been, announced. It's actually
supported by jobs.
By the job numbers on Friday, which were way above what the market was expecting. So the U.S. economy, we're calling it U.S. exceptionalism. Everybody, it's a new term you're going to hear about how strong the U.S. is. And the job market is very strong. So there's actually no need to really pull down inflation or do anything to stimulate the economy. It's running hard itself. So that's delayed the possibility of further rate reductions. Now we've got Trump coming in. Mr. Trump next week. This time Mr. Trump will be in, and there are a lot of fears about what he's going to unleash, particularly with tariff increases, with tax reductions, also looking at regulation, making things a lot easier, which the market has interpreted as being very inflationary. So we've got all these things to kind of juggle over the next few weeks. So expect volatility, expect confusion, volatility, which generally results in markets going nowhere. Yeah. Before you get worried, the one thing that is strong is that you're going to see U.S. earnings very strong. And that could be the support mechanism that we look at, and that keeps the markets going.
But David, I've looked at currencies.
Yes.
And if you look how the dollar strengthened, the pound today is below 122 to the dollar. Yeah. It traded a few months ago at 134. Yeah. So aren't those earnings earnings from other currencies outside of dollars, translated back into dollars? Isn't that going to have an effect on earnings?
Not major. I know we say it is, but I don't think it's as big as we think, and I think it's well managed. I know that a lot of the S&P is made up of, the American markets are made up of earnings that come outside of America. But the beauty about America is its own self-market. It's a huge market. It doesn't need the rest of the world. That's why you get this view of U.S. exceptionalism. They don't need to go and, you talk about the average America. I don't think they could pin the UK on a map. If you said, where's the UK, where's Paris, they have no idea.
David, every American living in Nevada couldn't pin Arizona. Arizona in Nevada. But
that's America.
Pin it. Yeah, that's America. But David, so let's just talk about the most important thing. Why, and people ask me this, we spend so much time talking about America. We live in South Africa, we earn in South African rands, and we talk about so much. Everything happen? They say when America catches a cold or sneezes, the rest of the world catches a cold. But is everything revolved around America?
Yes. Just think of what you use on a daily basis. Go back to your office, your phone, Apple, software in there, probably Broadcom or whoever it is, in the video. You look at your computer, the same kind of thing, Microsoft. Wherever you go, you're using American products, American technology, American skill. And it's a huge influence on our lives. And the companies are massive influences on the global economy. If you go back 10, 15 odd years ago, there was always this question about America, especially with the rise of China. And if you go back, you'll see America's held its own in the global economy. China's picked up, but Europe has lost an enormous amount of ground. UK has lost ground. Japan has lost ground. But America has held its own, and it's still an enormously strong economy. That's why I'm saying, catchphrase this year, American exceptionalism. It's still going to dominate everything that we do.
And then, David...
And the dollar, sorry. I think
the dollar's so strong.
Dollar's strong.
Going to continue, do you think?
Well, I hope not.
I mean, isn't that making it so expensive for anyone to import from them, you say?
Enormously, and it makes it very cheap for them to import.
Yeah.
It's very cheap for them. But I think the point is that we all thought, I'm going back to my September Jay Powell story, when he reduced rates. We all thought that rates were going to come down quite speedily in the United States. And if you go look at some of the big institutions in our country, we're calling the rand 16, 15, even as low as 14 to the dollar. We're 19. Yeah. That's how wrong we got it, and that's what's happened as rates started to pick up in the United States and money starts to flow back in from UK, from Europe. Those economies are battling. They're battling because of their exposure to China. China is really under a lot of pressure. They're trying hard. They're pulling all kinds of levers in China to get their economy. It's not working. Germany is, you remember how strong Germany is
economy,
to be under a lot of pressure.
David, before we take our break, and we're going to come back and ask about South African stocks, but I just want to ask you one thing. Do you see interest rates coming down by the end of the year?
In America?
Yeah.
Yes. Maybe by not as much as we expected. I think we'll still get another 0.5 to 0.75%, maybe even 1%. But we're going to have to wait quite a bit of time for it to happen. It's not going to happen next week.
Okay, well, stay tuned. We're going to be back shortly. We're going to take an ad break now. We'll be back.